A lot of people ask, are used car prices going to crash in 2023? We deep dive into the supply and demand mechanism and really explore where the trend's going. Let's jump into it.
With 30 years experience in auto logistics and state-of-the-art locations in 5 major Australian cities, Precar Fleet Services are a premier all-in-one solutions provider for commercial vehicle fleet operators, leasing companies and original equipment manufacturers. Please visit precar.com.au and click on the link to Fleet Services.
A lot been happening in the market this year, especially around new car and used car supply. What are your feelings about the used car pricing? Do you think there's going to be a big impact in the market with used car pricing?
Right now, if you look at it, there are 20 million cars on the road in Australia. That means that 20 million investors are really focusing on the value of those 20 million cars. There's 1 million new cars coming in each year on average. It's a bit like real estate. Everyone wants to know that their house is appreciating. Right now, we've got a real estate depreciation. And what we learned from the podcast with Gina from realestate.com is there's a correlation between real estate sales and car sales. So we want to know what's going to happen with the value of our current asset, which is a used car. And there's been lots of bragging over the last 2 years since the pandemic kicked in that, wow, my car is worth so much money. I'm a hero. I've done really well. However, it's all about supply and demand. So let's look at what's happening from a supply perspective. Now, when you look at the bigger picture, the challenge and trap that most OEMs and VFACs and auto journalists look at is this year versus last year, this month versus same time last year, or this month versus last month. Now, we know through the year there's seasonality of more new cars being sold during certain times of the year and more used cars being sold during certain times of the year. So let's start with the cycle during the year. Right now, January, February and March are strong used car months. Because what usually happens, and all of us have done it, we've just celebrated the Christmas break and New Year's and we've sat down at Christmas lunch and caught up with friends and so-and-so's got a new car and this person's got a new car. Or we've gone away on a holiday and realised we need a different car to the one we've got. We may have a small SUV, we need to upgrade to a bigger SUV. So these are all life-changing reasons to buy a car. And right now, these 3 months are a very strong time to actually buy a used car. Don't forget, there's twice as many used car sales versus new car sales. However, there's a curveball coming into play. To buy a car, you need money, and you get your money from 2 places. You either borrow it, or you save it, or redraw on your equity in your house. Because don't forget, most new car buyers are people in their 40s and older that have equity and have assets. But 2 things happen in March, April, every year that causes the market to dip. So what happens in March, you get an oversupply, end of Japanese financial year, and we know that 80% of our products in this country come from Asia. It's interesting that actually China's now creeping up, and China's now around that 11% of the total volume. But still the main volume comes from Japan or Thailand, and most of those are Japanese OEMs that need to report a big number, so March is a big retail sales month. So lots of demand leading up to the Easter break. After Easter, 2 things happen. We settle down because we've had our holidays from Christmas, and Easter is the last 4-day holiday that we have. Then demand falls off a cliff. So we don't need to buy any used cars because we've satisfied our need for the time being. Right at that same time, rent-a-car companies defleet because there's been huge demand for their rent-a-car activities in the southern states. They flood the market with some ex-rental stock. That comes in and brings the price down of those products in the market. Now, not all brands supply to the rental market, so it doesn't affect all brands at the same time, but it does bring the market down to a certain extent. So used car prices are very flat from basically after Easter all the way through winter and don't really start to return until, with any sort of strength, until around the August, September timeframe. The inverse happens from a new car perspective. End of financial year incentives mean that May and June are the biggest selling months of the year from a new car perspective. So prices are usually strong, but also there is incentives from the car companies to get you to buy a car during that period. Now, in a normal market where there's good supply and good and reasonable demand, there's some good value propositions to get those cars at that time. The other thing is those cars then get dumped, their trade-ins get traded in, and those prices drop. So there's discounting at the top end, but there's also an oversupply then of used cars. So you're going to see a little bit more used car pressure on pricing from the May, June, July timeframe, where demand for used drops, but the supply of used is increasing because of the increased supply of new cars coming in and people trading out of old cars. The other thing that the pandemic has done is it's actually meant that the cars that would have been traded 3 years ago or even 2 years ago have been extended in their duration of lease. So the quality of used car coming back, instead of being 3 or 4 or 5 years old, those cars are now 4 or 5 or 6 years old with higher kilometres because there's been more driving because there hasn't been any flying for a couple of years. So what we're going to see now is depreciation of the vehicle because it's actually not as good as what it was, say, 3 or 4 years ago for that same car because it's going to be older and it's going to be in slightly worse condition and potentially out of warranty. So these are going to put downward pressure on the used cars during that period. Now, right now, the car companies are catching up with production. They've been shortchanged stock here basically for 2 years. Now, if we think of the long-term trend of what is the actual number for the Australian market, a real number, if you go back to 2010 all the way through, say, to 2022, and you look at the average sales, the years where the market was in equilibrium was when these volumes were just over 1 million cars. In fact, 1,040,000 was a really good number. As soon as you go over 1,040,000, you start to go into a push strategy rather than a pull. So rather than supply equaling demand, it's oversupply. Therefore, there's pre-registration that forces those numbers up. And we saw pre-registration being particularly strong in the years from 2015 through to 2018. Where those years we actually had more than 1.1 million cars reported sold. Not really sold, registered or potentially registered. So here we have a situation where the car companies all have a target and everyone wants to sell more cars year on year. And the pressure is, well, I want to get a piece of this pie. If there's demand, I want to bring more cars in. Right now, we've had order banks, which have been great, but they're now starting to diminish and deplete because the other side of the coin is kicking in. What we're seeing now is a difficulty in getting credit, increasing interest rates, depreciating asset values in real estate, and also making it harder to get access to funds. So someone in a position that could easily finance a $60,000 car suddenly can only get approval to buy a $40,000 car. So that then curbs the new car sale, which then means there's a search for used cars, but it means that the stock that was coming in that was thought was going to be sold at 60,000 suddenly gets discounted. As soon as you start discounting new cars, it then puts downward pressure on used cars because the enemy of used car pricing, and I mentioned rent a cars as one thing, but rent a cars is only 5% of the market. The bigger single element of the industry that causes front-end depreciation is the demonstrator push. As soon as you see demonstrator sale, that means those vehicles aren't actually sold. They've been pre-reported sold, and there's a push to get that inventory out. So the demonstrator element causes downward pressure on the first registration. That means that if I'm trading a car in on a demonstrator, I'm not going to get the highest value that I was previously thinking because the new car's under pressure, so it's getting closer to the used car value. The used car value then drops down.
You're starting to see deterioration of economic conditions in Europe and some of the other world markets. How do you think that's going to impact supply of new cars in Australia?
Declining global demand is definitely going to impact Australia because what happens is the manufacturers that are based in Asia that supply these other markets, Europe or the US or even the other Asian markets, as they decline, the Australian market is seen as a very buoyant and a very profitable market to play in. What the perception is that, okay, well, we'll sell more cars into Australia because it's a very affluent market, it's a mature market, and you can push product in there. It'll be redirected in the production line. Obviously, you can't send a left-hand drive car here, but you can send a vehicle that was going to be built as a left-hand drive that is now being built as a right-hand drive, reschedule that in the factory. So the national sales companies here will be under more pressure from the overseas parent because fundamentally the overseas parent needs to keep the sausage factory going. The assembly plants need to churn out X amount of cars a day. Some have targets. When we had local manufacturing here, it was 600 cars a day. So you need to have the demand and the places to move that stock to sustain that factory because what you don't want to be doing is turning a factory off, on, off. That's not how you make money out of this industry.
So Mark, you're going to start seeing increased supply. So all the stock is coming into dealers and you're going to start seeing more stock sitting in terms of demonstrators and stock on the floor and used stock. What is the impact of interest rates on a dealer and how is that going to affect them?
Let's look at the three parties that are at play here. You've got consumers, you've got dealers, and you've got the car company, the OEM. Start with retail. Customers won't be able to get access to the finance that they could 12 months ago. So therefore, that means demand drops. also means that the price paid for a car drops, restricting demand for those vehicles. And the second impact here is the dealer. The dealer pays floor plan or interest on the inventory. So the dealer doesn't own the car. It's under a bailment arrangement with the finance company. And if the car comes in and goes out, it's beautiful. There's hardly any interest paid on the car. The dealer just gets it in, gets it out, gets money from the customer, pays out the finance, and away we go. As soon as cars start to stick, then the dealer starts paying interest on stock that's not moving. Now there's going to be interest costs to have those cars in stock. So A, the cars aren't selling because now they're arriving and they're sitting on the dealer floor plan for extended periods of time. That means that any profits start to get eroded by the interest bill on that stock. That then puts pressure on the dealer to discount it to clear it. So you're going to then get further downward pressure on the car. Then you've got the car companies, if they defund their stock, if they suddenly have cars on grass, they need to fund their floor plan. They may need to then put further incentives to clear it.
You've mentioned the interest rate on the floor plan of the dealers impacting profitability. How significant is that impact on the dealer profitability?
Let's look at pre-pandemic. The floor plan bill was huge because the dealers were sitting on a lot of inventory, new and pre-reported inventory. So 100% of the car is financed when it's new. As soon as it's registered as a demo or a used car, then a certain amount has to be paid by the dealer, 20% of the retail value, to cover that depreciation. So it definitely impacts profitability for the dealer, but also pushes down the pricing and puts more stock pressure to clear those vehicles, which means discounting.
There's a huge impact on the balance sheet KPIs, what's impacting their funding and restrict their ability to trade because the floor plan gets full and they can't bring in new stock because they're sitting with this older stock. So they have to get rid of the older stock before they can start bringing in newer models or stock that they can move very quickly.
When is the tsunami of oversupply stock going to hit? Because there's been 2 years of pent up, yes, we need more stock, and we often talk about the pendulum that swings. Pendulum never stops in the middle. It goes from oversupply, briefly spends time in an equilibrium, and then it went to undersupply because all the factories were closed. And then there's semiconductor shortages, so it stayed over here at undersupply. What we're seeing now, it's swung back. And if we think of the 1,040,000 or 1,030,000 is the real number, now last year we had 1,080,000 cars. So there's already a 40,000 correction on previous years where we're shortchanged. Now we're shortchanged in reality back in 2020 by around 80,000 cars. That was the number that probably was a healthy number to clear the old stock that was hanging around and get us into a balance of corrected stock. If we've caught up with 40,000 from last year, I can see the market pushing to a 1.1, maybe 1.12 volume this year. The question is, when does all that stock turn up? If it turns up at the back end of the year, that means that the uplift in used car prices is not going to happen. So you're going to start to see the demise through post-Easter. So the used car prices will drop through the end of financial year. They'll remain flat. They're not going to really have any uptake because there's going to be this oversupply towards the back end of the year. And don't forget, as I mentioned, the cars that are being traded in aren't good quality, low kilometre stuff anymore. So that then drives the price down. We'll end the year with the oversupply starting again, and then it comes down to what will the car companies do in 2024, notwithstanding that you've now got at least 12% of the stock, and it's going to probably jump to 15 to 18% that will come from China. So that turnaround time's a lot quicker, and those vehicles are a lot cheaper. We're already seeing Tesla go into the overcapacity situation where they're discounting, and that hasn't happened before. So they're doing that on a global basis because they've got a huge facility in China that is underutilized. So there's a bit of financial pressure on Tesla, as there will be on all car companies once they figure out, they need to still maintain their profitability with volume throughputs through their factories.
Already orders now are committed through to September, October. And once you place your orders on the factory, it becomes very difficult to cancel those orders. By the time you start to realize there's an oversupply situation, start trying to put the brakes on the stock, your impact will only probably start taking effect very late end of the year and early 2024. That's the difficulty about the market, is trying to manage those lead times and how you deal with the ordering and trying to assess what the supply and demand is.
It's a very uncomfortable discussion for the directors in the national sales companies to turn to their overseas masters and say, yes, you've charged me with growing volumes. Look at the great job I've done year on year. We're up. To turn around to them and say, well, now that we've got supply, and when you've been just saying, I haven't been able to get my increased missed targets because you haven't been able to supply. Now they'll say, you've got supply, why aren't you growing at 10%? Because all car companies will want their people to grow year on year by 10%. And who wants to have that conversation with their overseas MD or their regional MD to say, yeah, I said I was going to do 50,000. Well, we think the market's going to pull back, so we need to drop down to 48. That's not a conversation that anybody wants to have, or anyone in an overseas car company wants to listen or hear. When you look at the cycle that we're going to be going through, we will see a drop down after Easter, which happens every year. But what won't happen is that it's not going to recover to the point where you can brag about, well, I bought a car a year ago and I can get more than what I paid for it. Those days are going to be gone because there's going to be supply. And that's a critical point. And there's going to be less demand because finance is the ultimate driver in getting into a new car or a low kilometre used car. And it's that knock-on effect. They're not going to be more than what you paid, but they're going to return back to that traditional depreciation of around 30% depreciation in the first 12 months from what the retail price is. Select models will still be in demand like they always have been. Collector cars or cars that have a certain uniqueness to them, that there's high demand and low supply. But a mainstream vehicle with part of a Velocity brand, those cars will come back to that traditional, and it might actually be 25% depreciation.